Hi, I'm Tony Sycamore, Senior Market Analyst at IG Australia. US stock markets rebounded on Friday, supported by Megatech, and despite a firmer than expected jobs report that saw yields close at their highest level this year. Providing some comfort to the hot headline job numbers, average hourly earnings fell to their lowest level since the pandemic, and Fed Chair Powell's comments at the March 20 FOMC meeting that a strong labour market wouldn't necessarily warrant a delay to rate cuts. Furthermore, the Fed has made it abundantly clear that inflation data, particularly core PCE inflation data, is the key to cutting rates. In that light, this week's CPI and PPI data, which feeds through into core PCE, will come under close scrutiny and provide further insight into the timing and scope of possible rate cuts. Let's take a look at the chart of the S&P 500 and the Nasdaq to see where they are as we start the new week. So the S&P 500 kicked off the first week of the second quarter with a decline of around 1%. And most of the damage was done this Thursday here, or last Thursday, which did leave a legacy in place of a pretty bearish red engulfing candle. I need to see the S&P get back above this high here and above this 42.64 high to suggest that we can see a push up towards 42.50. And that would negate the short-term downside risks which have come from this red candle here and warn of a possible test of this support region coming in around 50-50-ish. Now, if the S&P 500, as we have mentioned in previous videos, were to break below this support area, it would indicate that firstly, we have likely completed a medium-term high, and that secondly, a pullback towards 4,800 is underway. Looking at the Nasdaq, a similar story. This bearish red candle from Thursday did see the Nasdaq close the first week of quarter two in negative territory. It has also left a bearish legacy in place, at least in the short term. And I would need to see the Nasdaq get above these highs through here, around 18,400-ish up to 18,464 to negate that bearish short-term legacy. If we were to break below this support band coming from the lows of February and March, coming in around 17,750 to 17,700-ish, I think that would indicate that we've got a medium-term high in place and that potentially the move up towards this 18,750 area has been negated. And secondly, it would open up a decline towards 17,000, which is initial support. Now, I suspect this is probably about the depths of the pullback. However, if it did start to unwind a little further, you do have the 200-day moving average coming in around 16,126. Thank you for listening and have a good week ahead.